Let's get an early look at what we can expect from our market today. Evan Lucas from IG in Melbourne joins us now for some opening calls. Evan, good morning to you. Of course, those central banks firmly in focus, both the ECB and the Bank of England and, of course, the Bank of Japan late yesterday. Quite a surprise there from Kuroda. Talk us through the reaction we've seen from risk currencies and commodities.
Okay, yeah. Good morning, Liz. I'll probably take it from sort of two sides. Let's probably have a look at the ECB and obviously what we also saw from the Bank of England. Obviously, the Bank of England, as expected, did absolutely nothing last night. It was expected. They did hold everything as is and basically kept the status quo. It was actually a little bit of a disappointment for currency traders. They did obviously therefore jump back into the pound and sort of push the pound a little bit higher. From the ECB sort of perspective, a lot of people had started to suggest that considering how we had seen the handling done with the Cypriot saga, that a lot of people were expecting them to change their tone ever so slightly, maybe look at a little bit more of a dovish view. They weren't expected to move on rates, and they didn't. They kept them at that 0.75%, but they were expecting a little bit more dovish rhetoric. It didn't come. It obviously therefore saw the euro particularly jump up quite hard against its 16 major peers. It pushed it up against the US dollar and also against the Aussie dollar as well, and it therefore meant sort of a lot of people are sort of asking questions about what needs to happen. A lot of people are starting to doubt whether or not Mario Draghi's sort of second half sort of expectations of growth in the ECB and in the Eurozone can actually occur. They're looking at basically talking about, again, them moving their rates lower, looking at basically increasing sort of longer term loans, similar to what we saw with the Litre loans last year, and encouraging spending in probably more sort of the small and medium enterprise space, which has been really struggling over in the Eurozone. So it did unfortunately drag their markets lower, push the euro higher, and that's probably what we saw and why we saw the Eurozone as a whole sort of pulling down, considering how well we saw the BoJ react. Moving to the BoJ, well, it was an absolute stellar sort of standout from Kuroda. It was well and truly ahead of expectations. There were three major standout points with what he sort of talked about. They're now obviously going to target the monetary base, not just the catch rate. Obviously, we saw them move their rates to complete zero. It means in real terms they've actually got negative real rates, which again means investors are going to be pushed out of bonds and they're going to be pushed back into other areas. That's the main reason for that. They're also now going to basically combine their asset purchase plan and the old Renban plan into one, and have the ability to now purchase bonds across the entire curve. Again, another reason to sort of push people out of that area. It means they can flatten the curve quite hard, push it down even further, and they've increased their stimulus spending by up to 7 trillion yen, well and truly ahead of the 50% of what people had expected. It's about 75% of that. It means they're now the second largest expansion monetary policy bank in the world behind the Fed. It really did obviously drive the yen straight through the floor. We saw the US dollar JPY trade now at the 96 handle. It's highest it's been in about sort of 6 months. The Aussie dollar yen trade is now at 100 yen and a bit over. That's the highest level the Aussie dollar's got against the yen since August 2008. It obviously pushed the Nikkei at the close up about 2.2%, and it does bode well for our region going forward with the BoJ really delivering.
Yeah, okay, so we did see that announcement from the Bank of Japan come out quite late yesterday. Do you expect our market to perhaps didn't have much time to react to that, and we could see a bit of a positive bounce on that today?
We certainly probably should. Also, the other thing to be aware of is that commodities as a whole actually moved up. The indexes of commodities actually moved slightly lower, but commodities led by copper and also by nickel moved up. We also saw the iron ore price slightly shifting up. It's about 135.9 US dollars a tonne. We also therefore saw BHP's ADR on that moving up higher over in New York. It's looking at about $32.15, $32.20. That's about a 1.1% gain. Therefore, it should see the material space finally picking itself off the floor today and bringing us up. We are calling ourselves up slightly modestly. I think you might find that we do get a bit of a pick-up today with what happened over Japan as Japanese investors now start to look at what they're going to do, particularly the ones that are holding bonds, and whether or not they obviously invest in the local market or move regionally as well. And obviously the ASX is one of those markets they obviously continue to look at. So we may actually see ourselves bounce up a little bit harder than we're currently calling.
And Evan, just before we let you go, US markets finishing higher on that Bank of Japan stimulus measures despite a disappointing weekly jobless claims report, and that of course coming ahead of that non-farm payroll report for March. What can we expect there? Do you think the market's going to be disappointed?
It's a very good question. I mean, there's two ways of looking at this, Liz. I think The silver lining to what we're seeing with the unemployment claims, obviously last night they did disappoint. They're up 28,000 from last week at about 385,000 claims that were coming in. We actually also saw last night that another one of the FOMAC members, he's a non-voting, but he is a major sort of influence in Dennis Lockout, coming out and saying that there's not enough evidence yet to sort of convince him that they should be obviously winding back their stimulus measures. The US markets have moved up quite hard on those stimulus measures, particularly that $85 billion expansion project. Janet Yellen, as we speak, is currently on the newswires as well, and she's probably going to reiterate what they have been saying. It therefore will put a bit of calm and a bit of ease on the fact that, yes, tomorrow's non-farm payroll would, if they did manage to get 200,000 or more, it would mean they've averaged that amount, and a lot of members are suggesting that that actually shows that employment is actually moving in the right direction. It may actually see them pull it back. So the silver lining on that is that if there is a disappointing number tomorrow, it will probably mean that the Fed will continue to hold their stimulus measures, and therefore you may actually see the US market move up despite the fact that the numbers might actually be poor.
Yeah, you mentioned Janet Yellen, and she is speaking at the moment over in the US, as you mentioned. Some of the headlines coming over those news wires saying that the Fed should focus on jobs, even if inflation edges past its target. No big surprises there, given how dovish she is. And she's next in line to be the successor to Bernanke when his term finishes up in January. So can we expect her to continue this sort of stance?
Look, I certainly think so. Janet Yellen and Ben Bernanke's sort of perspectives have been almost basically identical. He and her have both been all about the unemployment rate. It's their major sort of call and their major reason for currently doing the stimulus package that they have. They obviously aren't concerned about inflation, and inflation for the US is still holding fairly low and relatively in line. So that's their major figure. They are looking for sort of about a 6.5 figure at the end of next year and about 6 in the corresponding year after that. So that's basically what she's been concentrating on. It's been what she's been about for at least the last 3 or 4 major speeches that she has. And it's the same with Ben Bernanke, and the fact that there are obviously other members that are still holding that line tends to suggest that you'll probably see obviously the Fed Reserve currently holding their current stimulus measures for at least the interim to a shorter term basis as well.
All right, Evan Lucas from IG, thank you so much for bringing us across all those issues.
Thanks, Elise.